Something just broke, and I need you to see this before the morning headlines bury it under the usual financial noise. I have been tracking precious metals markets for over 15 years, and what I am watching right now is not just unusual, it is historic. My terminal lit up like a Christmas tree at 3 in the morning, with alerts I have never seen before in my career. And if you hold silver, or you have been thinking about buying silver, or you trade precious metals futures, you need to understand what just happened, because the game has changed permanently. Here is what is unfolding. 8 major banks just got exposed for one of the largest market manipulation schemes in financial history. And I am not talking about conspiracy theories or unverified claims. I am talking about verified court documents, Department of Justice settlements, federal prison sentences, and over $1.3 billion in fines paid out between 2016 and 2025. JPMorgan Chase paid $920 million. 2 of their traders are currently serving federal prison time. Scotiabank paid $127 million and completely exited the precious metals business. Deutsche Bank, HSBC, Bank of America, UBS, Goldman Sachs, Morgan Stanley, all caught, all fined, all on the record. But here's the part that should terrify you. After all those prosecutions, after all those fines, after 2 traders went to federal prison for rigging silver prices for 8 years straight, the market did not calm down. It exploded. Silver went from $28 an ounce in January 2025 to $83 by December 2025. That is a 260% rally in 1 year. And the banks that are still short silver are now bleeding billions. Let me give you the hard number that nobody's talking about. Between December 30th, 2025 and January 1st, 2026, physical silver in Japan was selling for $130 per ounce. Not $72, not $83, $130. That is an 80% premium over the paper price on the COMEX exchange. In Shanghai, buyers were paying $8 premiums just to secure physical metal. In the UAE, dealers ran out of inventory completely. Queues formed outside bullion dealers across Asia. This is not a normal market anymore. This is a market that is decoupled from reality. Before I take you deeper into this, please take 1 second and drop a comment telling me where you are watching from. Are you in the United States? Are you in Asia? Are you in Europe? Let me know, because this is a global story. And I want to see how far this information is spreading. And if you are new to this channel, understand something. I do not run an AI avatar pumping garbage content with fake urgency. I am a real person with real access to real data, and I built this channel because I was tired of waiting 12 hours for Bloomberg or Reuters to report what I already saw on my terminal at 2 in the morning. So you are getting the unfiltered feed here. No hype, no clickbait, just verified data and my honest assessment of what it means. Now let us start. JPMorgan Chase is the center of this story, and their fingerprints are all over the crime scene. Between 2008 and 2016, JPMorgan traders ran one of the most sophisticated price manipulation schemes ever documented. They used a technique called spoofing. That means they would place massive sell orders to drive the price of silver down, then cancel those orders before they ever executed. They did this thousands of times across thousands of trades. The goal was simple: manipulate the price lower so that their short positions would profit. And it worked. For 8 years it worked. But in September 2020, the Department of Justice caught them. The settlement was historic, $920 million in fines. That breaks down to $436 million in criminal penalties, $301 million in restitution to victims, and $172 million in disgorgement of illegal profits. 2 traders, Michael Nowak and Greg Smith, were convicted in August 2022 and sentenced in August 2023. Nowak got 1 year and 1 day in federal prison. Smith got 2 years. These are real prison sentences for real crimes. This is not a civil fine that gets paid quietly and forgotten. These men are serving time right now. And JP Morgan was not alone. Scotiabank paid $127 million in August 2020 for manipulating silver from 2012 to 2020. They also put aside $232 million in reserves to cover the fallout. The total cost to Scotiabank was over $360 million. That is more than the entire profit they made from their precious metals desk for years. So what did they do? They shut it down. In April 2020, Scotiabank announced they were exiting the precious metals business completely. They wound down operations in early 2021. That is an institutional admission that the compliance costs and legal risks were too high to continue. Deutsche Bank paid $75.5 million across 3 separate settlements between 2016 and 2021. They were caught rigging the London Silver Fix benchmark from 1999 to 2014. That is 15 years of systematic fraud. Their electronic communications became the smoking gun evidence that implicated other banks including UBS, HSBC, and Scotiabank. HSBC paid $76.5 million in two settlements, one in 2018 and one in 2023. Bank of America paid $25 million in June 2019 for spoofing precious metals futures from 2008 to 2014. Two of their traders, Edward Bases and John Pacilio, were convicted of wire fraud in August 2021. UBS paid $20 million across two settlements. Goldman Sachs paid $20 million in January 2025 for manipulating platinum and palladium from 2008 to 2014. Morgan Stanley paid $1.5 million in 2019. Add it all up, 8 banks, $1.27 billion in fines, multiple federal prison sentences. And all of this for crimes committed between 2008 and 2016. The prosecutions happened between 2016 and 2025. The convictions are final. The prison sentences are being served. This is verified history. Now here's the part that changes everything. After all that enforcement, after all those prosecutions, the market did not stabilize. It broke. Because what the banks were suppressing for 8 years was real physical demand. And once the manipulation stopped, the true supply and demand picture started showing through. And that picture is a nightmare for anyone who is short silver. The Silver Institute publishes a comprehensive annual report called the World Silver Survey. The 2025 edition documented something unprecedented. From 2021 through 2025, the global silver market ran a cumulative supply deficit of 820 million ounces. That means industrial demand, investment demand, and jewelry demand exceeded mine supply and recycling by 820 million ounces over 5 consecutive years. That is not a short-term blip. That is a structural shortage. And the deficit is accelerating. Solar panel manufacturers consumed approximately 200 million ounces of silver in 2024. By 2030, that number is projected to hit 300 million ounces annually. Each photovoltaic cell in a solar panel contains 111 milligrams of silver, and there is no easy substitute. Industry engineers estimate it would take a minimum of 3 years to transition to copper wiring in solar cells, because you would have to change reagents, retool factory equipment, and re-engineer specifications across thousands of production lines. That is not happening overnight, so solar demand is locked in. Then you have electric vehicles. Samsung announced a new battery patent that requires 1 kilogram of silver per vehicle. 1 kilogram. At current prices, that is over $80 of silver per car just in the battery pack. And EV sales are exploding in China, which represents 43% of global auto sales as of the first quarter of 2025. Even if EV adoption is soft in the United States, China is building millions of electric vehicles every year, and every single one of them needs silver. Then you have military applications. Each Tomahawk cruise missile uses approximately 500 ounces of silver. At current prices, that is $40,000 worth of silver per missile. On Christmas Day 2025 alone, the United States launched at least a dozen Tomahawks in military operations in Nigeria. That is 6,000 ounces of silver consumed in a single day for a single operation. And military demand is non-discretionary. When the Pentagon needs missiles, they buy the silver regardless of price. Here's the critical difference between silver and gold. Gold is hoarded. When you buy gold jewelry, it can be melted down and recovered later. When central banks buy gold bars, they sit in vaults forever. Gold that comes above ground stays above ground. But silver is consumed. When silver goes into a solar panel, it is gone. When it goes into an EV battery, it is gone. When it goes into a pharmaceutical catalyst or military hardware, it is gone. The recovery cost from industrial applications runs $150 to $200 per ounce, which often exceeds the commodity price itself. So industrial silver is effectively destroyed. That means every year, hundreds of millions of ounces of silver are removed from the available supply permanently, and mine production is not keeping up. Global silver mine output has been declining approximately 7% from 2016 peaks according to Silver Institute data. New mine development takes 7 to 10 years from discovery to production. There are no significant new silver mines coming online in the next 3 years, so the supply side is locked. Now layer on top of that the single most important catalyst of 2026. On January 1st, 2026, China implemented the most aggressive precious metals export controls since their rare earth restrictions over a decade ago. Beijing reclassified silver from an ordinary commodity to a strategic resource subject to government licensing. Only 44 companies received authorization to export silver in 2026 and 2027. That gives the Chinese government complete control over approximately 121 million ounces of annual exports, which represents 60 to 70% of refined silver traded globally. Let that sink in. China controls 70% of the world's refined silver supply, and they just shut off exports. Why? Because they need it domestically for solar panels, electronics, and electric vehicles. China exported over 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons. They are a massive net exporter, and now they are cutting off supply to the West while their own domestic buyers are panic buying physical metal at any price. Even Elon Musk publicly criticized the restrictions on January 3, 2026. He posted on social media, "This is not good. Silver is needed in many industrial processes." And he is right. Tesla, SpaceX, Starlink, all of Musk's companies rely on silver for battery contacts, semiconductors, and satellite components. But Beijing does not care what Silicon Valley thinks. They are securing domestic supply before the global scramble gets worse. So what happened to the price? It exploded. Silver went from $28 an ounce in January 2025 to $83 by December 2025. That is a 260% gain in 12 months. And it is still climbing. But here is where the story gets insane. The paper price and the physical price have completely decoupled. Between December 30th, 2025 and January 1st, 2026, COMEX silver futures were printing $72 per ounce. But physical bullion dealers in Japan were selling silver when they could find inventory at $130 per ounce. That is an 80% premium for physical silver over the paper spot price. This has never happened before in modern commodity markets. Gold occasionally sees 5 to 10% premiums during supply crunches. Silver sometimes trades at modest premiums in specific regional markets, but an 80% systematic decoupling between paper and physical prices across an entire continent? Unprecedented in recorded financial history. In Shanghai, physical silver premiums exceeded $8 per ounce above COMEX prices throughout late December. Buyers in China were offering foreign suppliers $8 premiums just to secure metal. Indian buyers were offering $5 premiums, and across Asia, Japan, Taiwan, Hong Kong, queues formed outside bullion dealers as physical inventory simply vanished from the market. When a market splits this violently between paper contracts and physical delivery, one of two things is happening. Either the paper price is fake, or there is no actual silver backing those contracts. I am betting on both. And the evidence is mounting that the COMEX exchange, which is supposed to be the global price discovery mechanism for silver, is running on empty. On December 12, 2025, the CME Group, which operates the COMEX exchange, raised margin requirements on silver futures by 10%. Then on December 29th, they raised margins again. Then on December 31st, New Year's Eve, when most traders were not even watching, they raised margins a third time. 3 margin hikes in less than 3 weeks. And 2 of those hikes happened during the holiday period when market participants were least attentive. That is not normal risk management. That is panic. When exchanges raise margin requirements during a rally, they force traders to post significantly more capital to maintain their positions. If you cannot meet the new collateral demands, your position gets liquidated automatically. This disproportionately affects smaller traders and retail investors who are leveraged long. Each margin increase triggered a wave of forced selling, which pushed the price down temporarily. This is called defending the shorts. The exchange is not trying to cool an overheated market. They are trying to protect the banks that are short and cannot deliver the metal. And there is one bank whose short position is so large it now threatens the entire system. According to investigative journalist James Henry, who reviewed mandatory regulatory disclosures, JPMorgan Chase is on the hook to deliver more than 5,900 tons of silver it does not have. Let me repeat that. JPMorgan sold silver contracts short, expecting prices to fall. They plan to buy back those contracts at lower prices and pocket the difference. Classic short selling, except silver did not fall. It tripled. And now JPMorgan has an exposure that journalist David K. Johnston calculates at up to $13.7 billion. That is roughly equal to JPMorgan's entire profit every 90 days. But here's the problem. There is not enough tradable silver available in COMEX warehouses to close out JPMorgan's position. The first CME delivery report of 2026 shows JPMorgan aggressively standing for maximum physical delivery. That means instead of rolling their contracts forward or settling in cash, they are demanding physical metal. Why? Because they are trapped. They sold silver they did not have. Now they need to buy it back to close their short positions. But if they try to buy 5,900 tons of silver on the open market, the price will explode even higher, and their losses will compound exponentially. This is the same bank that paid $920 million in fines in 2020 for manipulating precious metals markets. This is the same bank that recently relocated its gold trading desk from New York to Singapore, conveniently outside direct U.S. regulatory oversight. And now they are caught in the exact same trap that destroyed Bear Stearns in 2008. Analysts reconstructed Bear Stearns' precious metals losses at approximately $2.7 billion in gold and silver short positions during the financial crisis. Bear Stearns collapsed in March 2008 and was sold to JPMorgan for $10 per share, down from $170 at its peak. And guess who inherited Bear Stearns' derivatives book, including their massive precious metals short exposure? JPMorgan. So JPMorgan has been managing a toxic short position in silver for over 15 years, and now it is blowing up. And the Federal Reserve knows. On December 26, 2025, the morning after Christmas, the Federal Reserve Bank of New York injected $17 billion in emergency liquidity to an unnamed bank at 8 in the morning. Then on December 10th, the Fed quietly changed its repo policy to offer unlimited cash through overnight operations. They removed the aggregate operational limit entirely. Translation, the Fed is preparing for a major bank to need massive emergency liquidity, and they are setting up the infrastructure in advance. Former banking regulator Bill Black, who uncovered the savings and loan scandals in the 1980s, noted these cash infusions happen about every 5 years. Except this time, the Fed went 5 years and 3 months with virtually no repo deals. And now, there are multi-billion-dollar infusions happening roughly every third business day. Someone is drowning, and the Fed is throwing them unlimited life preservers. I cannot prove it is JP Morgan, but the circumstantial evidence is overwhelming. Massive silver short position, historic price rally, emergency Fed liquidity, margin hikes during holidays, aggressive physical delivery demands, all the pieces fit. Now here's what happens next. Silver futures are in backwardation. That means near-term contracts are trading at a premium to deferred contracts. In a normal healthy commodity market, the futures curve is in contango, meaning future delivery prices are higher than spot prices to compensate for storage costs and carrying charges. But when the curve inverts, when spot prices are higher than futures, that is called backwardation. And it means the market is screaming for immediate delivery. Buyers are so desperate for physical metal right now that they are willing to pay a premium to skip the line. They do not want a contract for March delivery. They want the metal today. Backwardation is the ultimate red flag that a market does not trust the paper system anymore, and silver has been in backwardation for weeks. The premium of spot over March futures hit 30 cents in late December. If it widens to 50 cents, that signals the paper market is collapsing entirely. At that point, the only price that matters is what someone will pay for physical metal in hand. And based on what we saw in Japan at $130 per ounce, that price is going to be a lot higher than whatever COMEX is printing on screens. So here's my final assessment. The banks manipulated silver for 8 years. They got caught. They paid over $1 billion in fines. 2 traders went to prison. But the manipulation created an artificial ceiling on prices that suppressed real supply and demand signals for over a decade. Now that ceiling is gone. Industrial demand is structural and growing. Solar, EVs, military electronics. China just cut off 70% of global refined silver exports. Physical premiums in Asia are running 80% over paper prices. COMEX inventories are draining. The Fed is injecting emergency liquidity to an unnamed bank. And JP Morgan is sitting on a short position that could blow up the entire system. This is not speculation. This is verified data. Court documents, settlement agreements, federal prison sentences, supply deficits, export bans, emergency liquidity injections. It is all on the record. The banks just got caught. And the silver secret they do not want you to know is that the paper price is fake and the physical supply is gone. Hold physical silver. Ignore the screen price. Watch the premiums. This is the beginning of the greatest short squeeze in commodity market history, and it is just getting started.